Check the markets here, open lower. As you know, we've turned around, though. We're basically flat on the S&P. NASDAQ's green, Russell's green, Dow's down about 0.5%. And I have to say, guys, the plethora of notes that are out today, the ones that I've seen anyway, are like 90% skewed positive. So you've got Ed Yardeni sticking with their call that the S&P bottomed on March 30th, 7,700 on the S&P. Mike Wilson, Morgan Stanley. Much of the adjustment for geopolitical risk, private credit concerns, and AI disruptions already taken place, already in the market. Mateka over at JP Morgan. Markets could show more weakness, but we stick with the view that if one has a longer time horizon, 3, 6, 12 months, one should be using the weakness to buy. In other words, buy the dip, V-shape. RBC, near term, yeah, fragile, foggy bottom, but bottom. So what do you think?
I don't think any of us suggested when the market was trading with that heightened sense of urgency in early March that was going to be a major inflection point. And we thought we were on the beginning of a precipitous decline, something like we saw in 2022. So I agree in the theory and the perspective that everyone has. I think one of the best dynamics that ultimately has happened in the month of March is when you look at positioning. And if you think of the institutional community leans defensive right now. The systematic community, they are basically carrying a neutral bias, which means they have a limited exposure. And then we did hear about the retail community making a little bit of a bearish turn for the very first time. So I think that setup is one of the reasons why you have the resiliency in front of you right now at a very rapid advance above the 200-day moving average. You're sitting there. So the theory and the bias of, yes, we want to be long the markets in place, but I think you still have to rebuild positioning, and that bodes well for further upside in the near term. Why
does the market maintain this resiliency? Because it obviously believes that earnings are more important than oil. At least right now. It doesn't, it's trying to look past the whole situation, Steph, with oil, and it is focused on earnings and the economy, kind of like you have, Ben.
Yeah, I've been buying since March, beginning of March, to be fair, not the bottom for sure. Better be lucky than smart. But I do think, the economy has been so resilient, led by the consumer, and the labor market, to me, has calmed down. We were so worried about the labor market softening. And while it's cooled down from the highs, certainly is solid. There's one job available in this country for one unemployed person. That's pretty good.
Do you believe what I said? Do you agree with that? Is it true? Is that the reason why the market looks like it does? Because it's more focused on earnings and the economy than the war in oil.
And I start with the economy because that's going to impact earnings. So yes, to answer your question short, yes, absolutely. We care more about the economy. Hanging in there, led by 70% of the economy is consumer. So we can't have that fall apart. Sure, there's problems with inflation. I got it. But they have jobs, and wages are growing 4%, and spending is growing 4%, and savings is growing 4%. All that is leading to better than expected earnings, and I expect them to be better than expected. And I think you're going to get kind of conservative guidance. It's the first quarter of the new year. It's always conservative. I think you're going to look for opportunities. I don't own Goldman Sachs, and I know we're going to talk about it, but I'd be buying that stock because that was a very good quarter. But what's the most interesting to me is since March 30th, the S&P 500 is up 7.5%. The Dow Jones is up 6%, and the NASDAQ is up 10%. If you waited, and I have said this many times, if you wait for certainty, you're going to miss some of the easy money to be made. And what I also think is really very interesting, too, is year to date, the Russell 1000 value is up 5%, and the Russell 1000 growth is down 5%. And there has been a massive rotation, almost liquidation in growth, in some parts of growth, especially software. Not all, but some, and that's really hurting a lot of people in the psyche, I think, of a lot of people that own growth.
I think Farmer Jim, in some respects, became Jittery Jim as this whole situation unfolded. I mean, you articulated as much on this program on numerous occasions. It even formulated part of your investing decisions. I'm thinking about
on holdings.
Yeah, on holdings. Yeah. Are you in agreement with the Yardeni, Wilson, Mateka, RBC idea that brighter skies are ahead and you need to focus on that? If you're always looking up at the sky for rain and it doesn't necessarily come, you're going to miss out on the sunshine.
I feel good, Scott. I do. And that's, appropriate. Bring up the on holdings. You were out Friday. I did add meaningfully to BlackRock. So I'm getting in. Like, if I thought things were worrisome, I wouldn't be making that move. I think we've had great discussions from you, Steph, and you, Joe, about the importance of earnings. I would say something that fundamentally the energy market is in much better shape than you might think. And why am I saying that? Because, yes, while West Texas Intermediate is whatever it is right now, I'm not going to look at the screen, $103 a barrel, Brent is cheaper. And you know it's cheaper than either Brent or West Texas Intermediate? Omani crude, which shot up to $160 a barrel in the heart of the conflict just a few weeks ago. These are the sort of fundamental esoteria that actually matters. And what it's saying is that the flows of oil and energy products through the Strait of Hormuz don't matter as much as they did 2 weeks ago. Now, let's not parse my words too carefully. Of course, they still matter. We're talking about $100 handles. But even if you look at where the most pain has been felt, the most pain has been felt in Dutch natural gas pricing. That's off meaningfully from those highs. And what it's saying is workarounds are being felt. Now, maybe for the same reason. And I'm not just going to continue talking about earnings. You already did that. That was fabulous. But if you look at things that have also perplexed us, worried us, things like high yield spreads, those have come down. You go back to January, and the Bank of America High Yield Index was about 265 basis points over Treasuries. It shot up to 342 in the middle of March. Where is it now? 284. That is a meaningful decline. And what I'm telling you is when you lift the hood and really look at the pieces of the fundamental engine, there are things that are going right in addition to earnings.
I'm going to guess that there are a few people, at least, out there who are listening to a lot of this and saying, man, these people are too complacent. They're in denial about what is actually happening within the Middle East. The risk at this point is that it gets a little worse before it gets better. If you believe the rhetoric and some of the on-the-ground dealings there, a lack of an agreement over the weekend, what's going to happen with this blockade in the Strait, I feel like I know it. I know there are people out there who are channeling that.
But why is the market so calm?
The market is telling you, I mean, to be up today, and I'm sorry, Joe, for the S&P to be green on the news we got yesterday, I mean, anybody who's an investor or a trader will look at that and tell you up on bad news is a sign. Don't give in. Don't give in here.
Okay, so Bryn, do you channel those that I just mentioned, or are you in agreement with those on the desk and the Yardenis and Wilsons and Matekas and gosh knows there's others out there who are just as positive on this market here?
Well, I try to be pragmatic, and I think that investors need to take right now as a learning point that history shows us, and this shows us right now, that markets adapt very quickly to the fogs of war. And so I think we've adapted very quickly. I think on top of that, if we haven't talked about yields, the 10-year seems very well anchored around 430, really hasn't moved. I think that's another big signal. We're well above the 200-day, which, that was really my biggest concern, is that we were going to stay under that 200-day for more than a month. We're well above that. And I think strategically, talking about the war, the U.S. blockading now the Strait is very smart tactically because China buys 85 to 90% of Iranian oil. And so if we have a full blockade, then that prevents that. And I've said all along, I think that China can be the player here to end this because they do need that oil. And I think that that's why President Trump said we're going to charge them a 50% tariff to try to say, hey, do not give the Iranians any missile defense. And I think probably that works. And I will say on earnings are strong. What's interesting, though, this quarter, though, is Micron and NVIDIA are going to be 50% of the total growth this quarter in S&P earnings. So we're still very concentrated. And I think that's why you can't count technology out, because almost all of the earnings growth is coming inside of tech.